Thank you to everybody. Thank you for coming to this investors call of Fasanara Capital. Over the course of the next hour, I will try to describe the core positions within our book and the outlook and the main views behind them. If you have the presentation in front of you, I'm on page 4 with our takeaways. There are 3 core positions that we like in the current markets. There is peripheral European equity, especially in the markets of Italy and Greece. Here we think that the main catalyst to our views is represented by the ECB having entered an active role primarily, and secondly also the AQR process, which is due to end and be released by the end of October. And the main optionality that we bought is in the Italian equity market and in the Greek equity market, primarily in the financial sector, which is going to be impacted the most by the AQR results. Secondly, we like themes around the deflation in Europe. We think that the deflation in Europe has just begun. It's going to be a very long process. It's not going to be a transitory market factor for the markets, but rather a structural one. We think that the ECB has become active because of fears of deflation, but it's actually probably already too late. Inflation moved from 2.5% plus in mid-2012 to 0.3-0.4% across European markets. So not only negative and close to zero and close to be negative in peripheral European markets, but also in Germany itself and Northern Europe. And we think that the ECB actions are going to be possibly too little, too late, and they're not going to be able to prevent inflation from moving into negative territory. A bunch of different strategies here is what we prefer in order to take a position. The bottom line of our views is that we see rates moving lower, close to Japanese levels. The 10-year at 0.50, 0.60 is not to be ruled out on the German bonds. The 30-year closer to the Japanese levels of 1.6 and even below that from 1.9% today. We think that such rates are unsustainable against GDP prospects close to zero and inflation going negative. So much is said about the fact that bonds are in a bubble territory, but they probably will be even more in a bubble territory. And actually what is happening right now is that the bubble is less so than it was before, because if inflation 2 years ago was at 2.5%, bond yields were justifiable, but with inflation now at zero, these bond yields are almost too high. And what is happening is that bubble levels in bond markets are closing, the fundamentals of the economy deteriorating is closing the gap to the level of yields. And in addition to that, we expect the spreads to compress, especially between core European markets and peripheral European markets. We expect the spread between the BTPs and OAT to move closer to 60 basis points from in excess of 100 basis points today, and also the spread between BTPs and bonds to move below 100 basis points from 140 basis points today. The third core position of our book has got to do with Japan. In Japan, we see the market entering the second phase of Abenomics. Second phase of Abenomics is following a first phase in which monetary printing has failed to reignite growth in any sustainable manner, and has also failed to kick in inflation. And especially the right type of inflation, not cost-push inflation due to energy bills rising on yen weaker, but also demand-driven inflation driven by wages and by consumer consumption. This has not happened. We expect the response of the policymakers to be more of the same, so more of the monetary printing in the absence of structural reforms and the third R of Abenomics, and therefore we expect more melt-up in equities, with the Nikkei hitting 20,000 possibly also by the end of the year or within the next 6 months, and the yen debasing further into 110 and 120 territory within the next year. On page 5, for each one of our core positions, you see the catalyst ahead of us. During the course of this presentation, we will go through a few of them in more details, and we will explain the background to our trades. But in a nutshell, in peripheral European markets, on the equity side, we see the ECB activism as one of the catalysts to our position. We see the ECB actions stepping up from here. So this is just the beginning of what the ECB will be brought up to do. For example, we think that at the moment the market thinks that the TLTRO will be enough, and TLTRO plus ABS purchases and covered bonds we think that is not going to be the case. It's not going to be enough. Sovereign QE is unavoidable. We think that the ECB later on in a few months from now will have to resort also to QE into sovereign bonds, buying bonds from peripheral European countries and core Europe, and that will bring yields even lower as inflation will go to negative territory. The second catalyst is the AQR, the asset quality review and the stress test due later in October, and finally geopolitics, where we see the main risk to the markets, which is the only new risk to the market, if you consider that the Middle East has been there for quite some time, is Russia and their standoff with the West over Ukraine. We think that is going to fade away, is a transitory factor for the markets, and that is therefore going to also provide some more catalyst, although it's only the third one to this view. The catalyst for the deflation, well, it's got to be really with the ECB actions. We see the ECB phasing three interventions. First, enhancing the terms of the TLTRO, later releasing a benign AQR, so an AQR not leading into massive capital needs for most banks across Europe, but rather a benign outcome, and finally delivering their own version of QE, and we will discuss what we mean by that. And third, the catalyst that we see on the Japanese core trades have got to do with the BOJ activism. We expect the BOJ to renew their commitment for monetary printing in the form of $60 billion equivalent per month into 2015. That alone will be enough to debase the yen further into above 110 against the dollar, and possibly even increasing that further into monumental levels. The second catalyst is the yen itself, which has got also repercussions for deflation itself across European markets, because when the yen devalues, that is exporting further deflation into other markets. And finally, something very interesting that we look at in Japan has got to do with the credit spreads trading at an amazing level, which is very amazing and very tight when compared with the credit risk that some of the private sector entails. So in the course of the presentation, we will provide some more background linked to these three themes. I would start with the deflation, which is what we focus on in this presentation, and the deflation, as we've been talking about it for quite some time. We think deflation is just showing its ugly face now for the first time, but it's not going to recede. We have seen the latest ECB meeting by Draghi leading to increase in long-dated yields. For example, the 30-year bond that we are receiving moved all the way from 170 to 198 a couple of days ago, and then today is 188. It's coming back a little bit. We think that sustained increase, that increase in yields is not sustainable, because inflation has become almost negative and is going to keep moving lower, and is going to take away the positive expectations of the current actions by Draghi being able to move inflation up as yet. So it's not enough what he's been doing, and it will be proved by yields moving lower, inflation expectation moving even lower than they are today. We think Europe looks like Japan in the early 90s. And we think that there are some structural issues having to do with Europe which are resembling the Japanese experience. In Japan, there were three conditions in the early 90s. There was a high level of indebtedness, which is bad because it draws away resources from productive investments into sterile debt service. There was an overvalued currency. At the time, the yen was overvalued, like it is today the case with the euro, especially the euro to peripheral European countries. A case can be made for the euro to be 40% overvalued against other markets globally in the face of peripheral European market, and 30% between core European markets and the peripheral European markets. Effectively, peripheral European markets is as if they had borrowed in foreign currency at this stage. In addition to that, one-third connotation, which is a very important one, is an inactive or slow to act or late in the game central bank. As it was the case in Japan, the BOJ dismissed deflationary risk, always thinking that the inflation expectations had not been disanchored from their target levels. History proved them wrong. Eventually, inflation became disinflation, and disinflation became deflation. It took 4 years for inflation to turn into outright deflation, and there were 4 years in the early 90s of inactive BOJ policies. Finally, some more structural trends like the falling working population and the falling productivity rates. The Japanese is the oldest working population out there, and is set to fall dramatically within the next 20 years. But the second and third oldest populations globally after Japan are in Germany and in Italy. So Europe lives off a similar background scenario of the one that Japan is seeing. On page 8, you see the hard data of European growth, which has gone very low, has almost grounded to a halt. This is not only true for Italy and for peripheral European markets, but it's also true for France, where growth deteriorated sharply, and for Germany itself, where it was actually negative in the second quarter, although only modestly so, and although some analysts have been saying about the front loading of GDP in the earlier part of the year due to good weather. On page 9, you see the picture, what it is. I mean, it cannot be seen any real growth in Europe for 2014. And if you turn to page 10, you see the grim picture in terms of inflation. Inflation is very close to zero. Across the euro area is 0.3%. And inflation is expected to stay de facto at zero in 2014 and 2015, and the market is hoping for some base effect to kick inflation a little bit higher over the next couple of months, but it looks like the trend is set and is quite visible. On page 11, you see inflation expectations as measured by the 5-year forward inflation swaps. The red line drew by Draghi is 2%. Draghi stated his unhappiness already at the Jackson Hole meeting at the end of August. His unhappiness to see these inflation expectations being disanchored from the 2% line. They currently stayed at 1.9%. They lost almost 20 basis points in the months of August alone. If you look at the 10-year inflation is below 1.5. If you look at the 5-year inflation is below 1%, and it is more than 100 basis points away from the US inflation. In addition to that, all of this is happening in a global deflationary environment. This inflation is not only true in Europe, is also true globally. If you look at the 32 OECD countries, domestic low inflation rates are below 1% for 70% of them. On page 12, you look at the US, for example. The US itself, here you see the 5-year inflation in the US at 2.71. You can clearly see that it's on the bottom end of the range. And despite GDP projections for the year, which is still very rosy, which we think will be missed, but at the moment is still coming in quite strong for the quarter. They talk about a number close to 5%. And despite that, the CPI is where it is. Quite tellingly, in the month of August, we saw a US CPI negative month on month, minus 0.2%, which was the first fall since April 2013. And quite tellingly, if you look at the core CPI, which last time around was at 2.9% year on year, a lot of it was due to the, it was 1.7%, but a lot of it was due to the housing sector, which represents 30% of the index, and which itself was up almost 3 points, coming back from very low levels, clearly. So you can also not trust too much or take at the face value the anyway very low level of inflation, even in the United States, which should be the one showing the most economic recovery, and therefore also rebound and this stabilization of inflation rates. On page 14, you see another thing. Like in Japan, it took 4 years for this inflation to become deflation. At some point, the central bank decided to get active. The advisor to the Japanese authority in the late 90s was Bernanke, so the same that is the father of QE policies in the US, and he tried the similar activities in the late 90s in Japan. Here you can see the money base, how much it increased, and the low effect on inflation for a number of years in a row. So you can clearly see that the effect of even monetary printing, and even a bold one, on inflation rates can be quite delayed, and the success rate is nowhere close to par. On page 15, you see the characteristic of Europe today. The euro, first of all, is far too strong. You compare it with the GDP prospects for the eurozone, you compare it with the productivity rates for the eurozone, and then debt against the US or the UK or other countries and big blocks around the world, and the euro is far too strong vis-a-vis what it should be. Why is it so strong? Well, it is so strong for a number of different reasons. So there was a current account surplus. There is a current account surplus, which is quite misleading because it's 200 billion, but it's misleading because it's overshadowing imbalances across countries within Europe. And in addition to that, it is strong because the balance sheet of the ECB for the last good 2 years was allowed to shrink by more than 1 trillion euros, which is a big shrinking. It happened because of the leverage flows, and it happened because of LTRO repayments. And it was in stark contrast with most other central banks around the world. If you think about the Bank of Japan, the Bank of England, the Federal Reserve, but also if you think about other central banks with countries which are in no similar state to peripheral Europe, like in Switzerland, in Denmark, even then, strong currency debasement was implemented in order to debase the currency, have a weak currency, and get out of trouble and out of an over-indebtedness through currency debasement. In Switzerland, more than 300 billion euros were bought in international reserves in order to defend a low level for the Swiss franc against the euro, with a floor imposed and manipulated around 120. And that obviously did the Europeans no favor, and incremented the bid on euros in the market, and is one of the many reasons why the euro got stronger. At some point, the SNB, the Swiss National Bank, accumulated the reserves for more than 60% of its GDP. And we remember that China was defined a currency manipulator at only 40% of GDP, with a fast rise in GDP, rising by 10 to 15% per year. So clearly, a lot has been done, and a lot can be ascribed to the strength of the euro. And Denmark itself brought interest rates to negative territory well before the ECB today, in order to defend the weak level of its currency and defend its economy. So, but there are other reasons that have led to a strength of the euro, which have got to do to the crisis resolution policies elected by European authorities. As we know, they took the view that austerity had to be the receipt in order to cure the European malaise, and lack of reforms was blamed for the European malaise, whereas the real problem was really a structural lack of demand, which was a global lack of demand and a very big lack of demand for European markets. What austerity was intended to do was to, level off the imbalances across European countries. What it means in the presence of a fixed exchange system, in the unavailability of nominal depreciations of your currency, because your currency is linked to the Deutsche Mark by the euro. Then the only alternative was to drive internal devaluation, which means push down the level of prices, wages, salaries across peripheral European countries until the gap of competitiveness was closed between them and core European countries. And the internal devaluation itself, like the name says, is a form of deflation. So it has gone into the direction of decreasing inflation rates across all of the euro area. It was supposed to be a laboratory experiment for Italy to become as competitive as Germany, and Spain and Greece and Portugal the same. And it can be said that it metastasized around, and it became not a laboratory experiment, but it became true for the whole euro area, where today the inflation in Germany is itself very close to the zero line. So now we move to page 16, and we see why inflation rates close to zero are that bad when there are high level of indebtedness. Well, before saying that, let me say that structurally, globally, there are other factors that can be ascribed to deflationary trends. There is the so-called Amazon effect, robotics, technological advances. It's obvious that they push down the unit producing cost. We also see lower energy prices due to shale gas revolutions, discoveries, and the end of the commodity super cycle. We also see weaker than potential growth. We see a slack in the labor market pretty much globally. We see a weak level of the dollar as a result of the zero interest rate policies. we see like the yen devaluation, which has been exporting deflation, and if the yen goes between 110 and 120, it will export even more deflation than it has done so far, which won't help Europeans, but actually will manage to make sure that the HCPI in Europe become negative. And finally, obviously, China has been the largest buyer of commodities for 10 years now, for some of the commodities by more than 80% of global demand. And you can see what happens now when China tries to rebalance their growth from being fixed investment driven to be consumer demand driven. Iron ore is falling off a cliff. It is going down together with copper and so many other commodities. And so a soft landing of China can clearly only call for more disinflationary pressures. Why is inflation again that bad for a country which is very indebted? Well, because if you have a zero inflation rates and you have a debt on GDP like Italy, for example, at 140% by year end, it means that you need to have a huge primary surpluses in order to prevent your debt ratios to increase further from those 140%. And the equation is very, very simple. It's primary budget balances. Whenever they are lower than the difference between the real GDP and real interest rates, they manage to increase the debt ratios almost mathematically. And that is why, for a country like Italy, for example, you had austerity measures. You had a primary surplus of 2%, and despite all of that, thanks to this inflation and thanks to like a GDP contraction and GDP being in negative territory, the debt on GDP increased further, and it is going to set from 135 to 140% already by the end of the year. It has been calculated, and I'm on page 17, that if Italy wanted to stabilize their debt on GDP ratios at zero inflation, they would have to have a primary surplus of 8%. 8% is obviously impossible to achieve, and it would be very detrimental and self-inflicted pain if one were to achieve that, because it would mean only more internal devaluation. It would mean more declines in unit labor costs, in salary cuts, more unemployment, less consumer spending, and less corporate investments. But we see that also the case is very similar to Spain, and even for Germany, the case is very seen. The case for deflation is very visible. So what can we do out of all of that? On page 18 we see that like the good part of the story is that we think the ECB will be forced into further action, into stepping up their efforts. We think that they have more bullets to shoot, and they will shoot that. We think that the ECB will engage in unconventional monetary policies, leading to the creation of the ECB very own version of QE. The ECB very own version of QE has already been detailed. The first signs of it have already been detailed in the form of ABS and covered bonds, but we think a sovereign QE will also take place. We think that possibly it will encompass also equities at some point, similarly to the Bank of Japan. And we think that at some point we'll also go hand in hand with a fiscal program, ECB financed, on infrastructure, on a new energy plan for Europe, on energy efficiency, and so on and so forth. We think that Germany is the key determinant to that view. Germany obviously has got to be on board for the ECB to be able to embark on those policies. We think that the time is right for Germany to be on board. We think that we have seen it already, because effectively the decision already in the early June for the ECB to engage into forms of quantitative easing and the injections of liquidity in the market, was unanimous in the ECB committee. Already at the beginning of June, it was reconfirmed at the beginning of September, and we think that the reason for that is a fewfold. First of all, the German economy itself is contracting, and that happens after they imposed on themselves their policy receipt of austerity, and so it's not good to see them contracting after so many years of virtuous behavior. The second reason is inflation in Germany itself is borderline negative. So if there was any Weimar-style inflation risk, it should have been put to rest by now. In addition to that, Germans are probably less concerned than before with moral hazard on the side of particular European markets. The current mainstream parties in Italy, Spain, France, Greece, they are the best that Germany can aspire to. They've all married their political agendas to the rules of austerity, although asking for some more growth-oriented policies. And some of them have also made sure that at the next elections they won't be re-elected, like in Spain and in France. So Germany cannot hope for for much more than that, and surely new governments being elected are less likely to take the German diktat at face value, one could expect. And finally, the fourth element is that the confrontation with Russia has increased the cohesion across European countries, the need for a common European energy policy, and also defense policies seems to be felt, and that will probably help the case for more integration across Europe, the banking union discussions, and so on and so forth. On page 19, what do we think this QE will bring up? We think that equity and bonds will melt up. We think that there will be a first phase in which equity melt up, especially in peripheral European countries, and we think that bonds will also move higher, with yields moving lower because of deflationary pressures and because they don't justify anymore the level of growth and the level of inflation in the market, both being at zero. If inflation and the growth are at zero, why should be the 10-year be at 100 basis points? That is difficult to justify in pure risk premium terms. And whether these ECB actions will be enough to avert a debt crisis and a multi-year Japan-style deleverage, we are not quite sure. We ourselves have got very negative views about that. We think that eventually down the line the case can be made for the euro to possibly break in an attempt to save the European Union itself, but this is far too away from us for us to see now. The foreseeable future is the next 12 months for the market. We think that as the actions of the ECB are stepped up, the markets will look at it positively, and that will lead to higher prices for bonds and equities in the next 6 to 12 months. I would turn to page 21. Moving the focus now more on the ECB actions. You see that what happened on the September the 4th. The interest rate was cut by 10 basis points to 0.05%. The deposit rate was cut into negative territory, and the commitment was made clear for Draghi to, by Draghi for a 1 trillion euro injection. Also in between TLTROs, outright purchases of ABS and the cover bonds, etc., etc. The Draghi said very clearly that he expects the balance sheet of the ECB to move up to where it was in 2012. That is what we see on page 22, and we see that that means 1 trillion means the peak of the balance sheet of the ECB. We think about the euro dollar. The euro dollar, we think it will be at the end of the year at 125, and at the end of the next year at 120. The reason for that is that in 2012, in 2012, at the time in which the ECB balance sheet was at that level, the euro dollar was on average 125, right before the third quarter of the year when the US launched the QE3. At that point, the euro dollar moved all the way above 130, eventually going all the way higher into 138 territory. So that gives a clear measure of what is in the mind of Draghi. Now, it's very interesting to see that in order to get there, he needs to buy or to lend some 1 trillion euros, which is quite a lot of money. And we will analyze numbers here, but we will see that it's not easy to do that through ABS and through cover bonds. So it's very easy to imagine that if he really is serious about it, and he is, and if inflation goes into negative territory, it will even urge him to move even faster. Then he will need to buy what's available, which is government bond debt. And there the offer is plentiful. Italy alone has more than 2 trillion on offer, but he will need to do it pro rata across European countries, and he will very likely be forced to do. On page 23, we see the average of the balance sheets across central banks, the ECB, the SNB in Switzerland, the Bank of Japan, the Federal Reserve, and the Bank of England. You can see how far off from the average the ECB is. If they wanted to bridge the gap and move into average, they would have to expand the balance sheet by 3 trillion euro. Not necessarily they will do that, and they will have to do it, but clearly the maneuvering space is definitely there. It all revolves around how desperate they are. Are they as desperate as the Swiss? Are they Japanese? Or just as the the UK and the Federal Reserve? We think they look like Japan, so they probably won't go all the way through that much, but definitely between now and the average, they have ways in which to implement. On page 24, we see we detail with precision what we think the ECB actions will be. First phase will have to do with enhancing the TLTRO's conditions while stepping up the rhetoric about quantitative easing itself. We think that a number of things can be done in this respect. The second phase will be releasing and going through a smooth AQR process. If there were some doubts about what the result might have been, now that we are in this inflationary territory, now that the GDP has contracted to negative levels across Europe, we think that the AQR they will make sure that the AQR is not too disruptive, more than it has been already over the course of the last year in bringing banks from, in withholding banks from lending to the real economy, and so contributing to the lower GDP figures, the higher unemployment, and the more disinflation coming to the markets. The third phase will be unleashing the ECB own version of QE, which has got to do with some of the ABS coverable bonds, but also sovereign QE, and also moving on to equity, and also moving on to a fiscal program having to do with infrastructure. On page 25, we see the enhancing TLTRO. In a nutshell, it can be done cost-wise and quantitative-wise. Cost-wise, they've already started cutting the 10 basis point spread over the refi rate, which can be brought even lower. And quantitative-wise, at the moment, there is an initial allowance of 7% of banks' real economy loan books that can be taken off or can be taken up to 10%. And all of that will make sure that the take-up of the TLTRO is as high as possible. The take-up of the TLTRO is very important because, obviously a measure of success of the ECB policy is how much is being taken. It's interesting to see that already that the bids for September were very low. In the region of 80 billion euros, and they are very low also because, incidentally, TLTROs coincide with the LTRO repayments, the old LTRO repayments, so the net effect was actually very small. It was to be expected because the banks don't know exactly what the AQR will force them to do in terms of replenish capital ratios, and so clearly they don't go they don't go into more borrowing, so they kept their bids quite low. In December, their bids can be expected to be higher, substantially higher. The market will surely equate those bids to the expansion of the balance sheet of the ECB, and that will have important repercussions for equities in Europe and for the euro-dollar. We expect the bids in September to be high, but what can also be seen is that if they are not big enough, the first reaction for the market can be negative, but then after a while it can actually be a good outcome, because if the TLTRO are not that successful, more has to be done by the ECB in the form of outright purchases of assets and securities, private securities, and therefore, a low turnout and a low take-up of the TLTRO can actually end up being more market positive than otherwise. On page 26, we see the preconditions to stepping up the rhetoric on QE have been taken away by the market, have been met and been checked by the markets. Draghi drew their red line on inflation expectations. As I said, inflation expectations are below 2% for the 5-year forward, currently at 191%. On page 26, you see, where numbers are across the euro area, and they clearly are into a level where Draghi can step up its rhetoric about QE without being blamed for destabilizing price stability. If anything, the opposite argument can be made from so many countries from peripheral Europe that the price stability is not preserved because with low level of inflation rates, debt ratios can only increase, and they can only damage the adjustment process in the fiscal programs, in the austerity programs, and make it impossible for it to be sustainable. On page 27, we look at the conditions across the euro area. They are obviously very negative, and they are those that they've led into where we are now, and the need for actions from the ECB. PMIs have been falling and free falling. Consumer confidence have moved lower, deteriorated in the last 5 months, as you can see on the chart on the right hand side. On page 28, we see like the TLTRO, and here the point of the market is that the latest take-up has been 82.6 billion from 255 banks. The lower it is, the more stimulus will be required. And here you can see that the TLTRO, there will be TLTRO 3 in 2 tranches between September and December, and then there will be TLTRO 4, the details of which are still to be released, but you can see that it span a period of 2 years. So here the point that we wanted to make is that Draghi used to be a master of war when it declared that he was standing behind the euro at whatever cost. With that cheap talking, he managed to get the markets on his side, and that cheap talking was even more effective than LTRO themselves, which was hard euro cash. You can imagine how much Draghi can be effective now that he's got all of these levers to play with, cost-wise, quantity-wise, on TLTRO, so many different dates in which the money can be taken. He has disposed himself into a privileged position where he can shoot in many different directions. On page 29, we see the initial take-up from various banks. You see how much those banks in single currencies, in single countries can demand and are expected to demand for TLTRO amounts. You can see the numbers for Italy, how much has been the initial TLTRO request, 75 billion, and how much is expected over the course of the next 2 years for an additional 74 billion. Numbers are quite big in Spain in particular, but they really affect all major markets in Europe. On page 30, you see the second catalyst that we expect. So the first one is TLTRO, enhancing the conditions on the TLTRO, stepping up the rhetoric on QE. The second catalyst has got to do with the AQR. As you know, the AQR is this big event, big catalyst expected for later on in October, but the results have already been delivered to the banks this month, and this catalyst event is supposed to create clarity about the balance sheet and the asset side of banks in Europe, which is supposed to clear all confusion about the true value of those assets. At the moment, only ruled by internal credit ratings of banks, and from that time on, the ECB will take their supervisory role. The dates are set, so we have in mid-October the results will be published. At the beginning of November, within the beginning of November, the capital plan will be submitted by banks, and then the banks will have to cover their capital shortfalls within the following 6 to 9 months, by May, July of next year. We think that it will play quite quickly. The banks will already be in a position to go to the markets and fill the gap in what they have to do in the markets, and so that the process will move much quicker than that. This is a very catalyst event. It should be said that AQR had unintended consequences this year because of the need to clear up their numbers and replenish capital. Banks have been doing a lot of things that were not very helpful of real GDP formation to the real economy, and they actually possibly contributed to the deflationary trends. They contributed to the high level of unemployment because in order to replenish capital, obviously they decided to delever themselves, to pay back the LTRO, to sell some assets whenever they could, to decrease their lending and do not roll it off to the household and businesses in the private market, and obviously that has had the deflationary pressures and deflationary implications. If you think about the Italian market or the Spanish market, where more than 70% of the employment is due to small and medium-sized companies, those companies, they rely almost exclusively on the banking market. So the AQR, pushed these banks into the leveraging mode, and these banks have pushed these SMEs into the edge at a time in which the GDP itself was contracting, inflation was very close to zero, rates were raised, taxes were raised because of austerity policies, and the reform in the labor market were very slow to advance, as can be seen today, for example, in Italy and their discussion about the Jobs Act. So AQR had unintended consequences already big enough. So we expect the ECB, if the ECB was uncertain about how to handle the AQR process, we think our expectation is that it should be clear now, and it should be make sure that the process is not too destabilizing, inflicting even further pain to the European market, and if a pro-growth policy is to be selected, it should start first and foremost from the AQR process next month. On page 31, you see the threshold for the AQR. There is a Basel III CET1 rate at 8%, and then a phased-in ratio in an adverse scenario above 5.5%. It should be said that we think, and on page 32, you see the type of shocks that they apply on banks' balance sheet. It should be said that we think that most relevant banks have done their duties, have done their homework, and they set themselves up for a positive test next month. So we're quite positive about this catalyst. We think that it will prove to be a non-event, meaning that it won't entail big capital needs from banks, and at the same time it will prove to be a big event because it will uncap the performance of these banks, which have been not liked by the markets for many months now. They've underperformed the market. The XX7E, which is the banking index, has underperformed the market, but the overall XX5E market in Europe by more than 5 points since June, which is when the ECB engaged in the battle against deflation for the first time, and that is hard to explain in the context of the ECB policies, and the one justifications that we give has got to do with the expectations of the AQR looming ahead of them, together with a string of bad news from litigation risk and litigation cost, all the way from Deutsche Bank to BNP Paribas cutting the dividend and so on, to profit warning like for Erste Bank, jump to default like for Banco Espírito Santo in Portugal, and so the string of news has been very negative. In addition to that, the ECB policies at the time were interpreted as being too weak. Now they've been stepped up already, and in addition to that, the AQR was creating this big Damoclean sword, which is going to be lifted, and this cloud is going to be dissipated by the end of next month. What I've just described is visualized on page 34, where you can see the underperformance of the banking sector and to date. And on page 35, you can see the fears about the AQR dissipating by late October, and you can see what happened, what I was describing between the capital replenishments for banks, which pushed the bank to cut on new lending and therefore to increase the negative impact on the real economy, contributing to internal devaluation, to unemployment, to economic contraction, and to disinflation in the process. On page 36, you see the summary of the views about the AQR. There is a positive scenario in which the AQR proves to be a cathartic event, and therefore we see the upward trend on the banking index, which is visualized here, resuming. It has debunched from the trend. We think it will go back in trend and move higher. If there is a negative scenario, which we don't expect, we see the risk. There is the risk of a debt crisis and a multi-year Japan deleverage, because a lot of the bonds here, we see the case for Italy, for example, are owned by foreigners. In case of a very negative scenario, you can only imagine, those 600 billion euros plus of Italian BTPs owned by foreign institutions, because still the local banks own a lot, but only 500 billion, and the rest is still in foreign hands. And you can imagine what happens to that, with a debt on GDP at 140% and unemployment, yes, unemployment at 43%. That is, very difficult not to call it a debt crisis, and it's very difficult to imagine what the consequences can be of that. On page 38, we see the third phase of ECB policies. So we said enhancing TLTRO while stepping up the rhetoric on QE. We said releasing a benign AQR smooth process and leave it behind us. And the third is unleashing their own details about quantitative easing program. What do they mean by that? And here, as we said, they talked about ABS and covered bonds. The two together, they can be contributing 400 billion. Actually, the target for it can be 400 billion, because 600 billion should be taken care of by the various phases of TLTROs. But it is very difficult to spend 400 billion on them. The ABS market in total is 1.2 trillion. There is a European ABS market for 1.2 trillion, but only 20% of it is distributed the Eurozone ABS. And if you look at the ABS of the SMEs at the moment, not the ones going to be issued, but at the moment, it's only a few percentage point out of it. So you're talking about a very small market in Europe for it. And Covered bonds is bigger, is 1.5 trillion, so a bit more could be done there, but we think that it's very difficult for them to avoid jumping into the next phase of QE, which has got to do with the foreign and private assets, including equity QE. On page 39, you see our scenarios. If we are right about the ECB policies and the deflationary forces, we think that these two will play as two weapons firing in the same direction. So on the one hand, the ECB policy buying eventually also government bonds. And on the other hand, there is the deflationary forces which are just at the beginning, so they will continue from here on. What do we think the results are? Rates going to lower territory. We see the BTPs at 2% soon enough within the next 6 months, and we think they will trade at a 100 basis point spread over bonds and 60 basis point spread over OATs. It's at the moment the spread over bonds is 140 basis point. It is very difficult in a zero inflationary environment to justify 140 basis point when the 10-year risk for bonds overall is 100 bips. And also should be said that real rates in Italy, given the fact that the inflation is even lower than in Germany and France, are much higher than in France and Germany. Real rates are 200 basis points higher in Italy than they are in France, and 250 basis points higher in Italy than they are in Germany. So a lot is said about the fact that sovereign bonds yields are already very low, but it should be considered that real rates are still very different across European countries. The fragmentations of the credit markets is therefore still very big, and it will be difficult to close it up in the absence of outright flows, even on government bonds. And then, as we said before, it can be said that bonds are in a bubble territory if there is some GDP growth of 2%, even just, and if there is some inflation of the ceiling of the ECB, which is 2% again. But if there is no inflation and no growth, the bonds are in less of a bubble than they would be otherwise. And you could argue that the fundamentals have adjusted themselves up to the level of the bubble on bonds, making the bonds where they should be. Credit spreads narrowing is the next phase that we see. Yields plummeting, we said it already. Equities melting up. This is what we think is that in a first phase where the ECB steps up its policies, it will result into higher levels for bonds, but also for equities, especially in the peripheral European markets where we see a substantial upside, and we want to play that through optional strategies because volatility is at rock bottom levels, especially implied volatility, whereas in the realized, we can see a lot of variations within the day on a lot of these markets. And so we think that bubble levels will be reached before eventually bursting later on, 2 years from now, when these policies might result to be too little too late anyway. And we don't know about that. That's early days to visualize that, but surely within the next year we think the environment will be supportive for bonds and for equities in Europe, especially in peripheral Europe, especially in Italy and Greece, as far as we are concerned. Geopolitical risk on page 40 and 41, we think that this is a transitory factor. Russia has a lot to lose in the confrontations with the West. Russia has got more to lose than the West in the confrontation. A lot has been said about the fact that Russia and the escalating tensions could bring up minus 0.5% GDP growth in Europe, which would mean that Europe would be in a recession. It's very bad because GDP is already at zero, and it's very bad because inflation is already at zero. It is a recession risk, which is very bad because unemployment is already very high. But at the same time, the risk for Russia is much bigger than that because it's an outright default risk. What we analyze here is the fact that looking at the numbers, the Russian economy is not so much or is not different enough from the economy that Russia had in 1998, which is last time around when they defaulted. It's not expanded much more beyond the industry in which it was strong at the time, which is energy and power, metal and mining. And it's true that the situation there was different from the viewpoint of that there was a fixed exchange system. The economy was going away from a Soviet era style, but at the same time the differences are not big enough beyond that. If we look, for example, at the external reserves, they are very big, but also the external debt are very big, and they are much bigger in relative terms. They are 4 times bigger than they were back then. Russia total indebtedness, which is primarily with the private sector and with the corporate Russia, is in excess of $700 billion. For most of those companies, it means that they need to refinance them by around 10 billion a month, and that is very bad when you are in embargo-like conditions from most of the rest of the world. The debt of non-public foreign debt in Russia was only 30 billion in 98, and it was only 464 billion in 2008. Today it is 715, which is 36% of GDP, and the highest of an emerging market, with the exception of China alone. Against all of that foreign debt, you have foreign reserves. They are almost 400 billion for Russia, but again, it might be not enough if there is a currency crisis, and the ruble has already started to depreciate quite dramatically above 38 to the dollar. And in addition to that, the big risk for Russia is that the oil price goes lower. It is going lower already, despite the geopolitical tensions, not just in Russia and Ukraine, but also in the Middle East, also in North Africa. The oil was not able to live off any sustainable rally above $100 per barrel. Today the WTI is 92, the Brent crude is 98 and going lower, and so the pain level is very close here. And in the 1998 there was devaluations of the ruble. It's different than today. There was a 70% devaluations in 1 month alone, but then there was also a strong recovery the year after, because the Russia contracted by 5%, but then expanded by 5, 10%, and 5% in the following 3 years. But back then there was a strong commodity super cycle. There were rescue loans by the IMF and the World Bank, international access to the capital markets. Today, Russia, as it is today, faces economic isolation, a weak commodity cycle, which is going to be even weaker now that China has decided to move away from fixing investment policies. And you can see what happens to the iron ore, the copper, the oil price around the world. And in addition to that, the war expenses. So on a positive note, we think that a resolution can be found because it is in the best interest of Russia, because Russia is clearly the main determinant of any resolution down in Ukraine. So we think that eventually this geopolitical risk will fade away, compromise will be achieved, and this will possibly provide a good catalyst for the markets overall. On page 42, you see just company by company in Russia and the foreign debt due in the next 12 months. We're talking about $45 billion, which compares with the National Wealth Fund at $85 billion. And page 43, the Scottish referendum. I mean, this is not worth discussing it any longer because it's off the screen. It would have been very bad. It would have been a real strong negative tail scenario, not so much for as much as it mean to England and the UK, but beyond that for the repercussions on Catalonia in Spain, and in general for the UK elections next year in May, and in general for the possibility of a referendum to bring the UK outside of the EU, and for the possibility of a yes vote to win that referendum. So now that Scotland is a kind of taking care of the risk list, good expectations can be had about the remaining risk. At least they've not increased as a consequence of the Scottish results. The opportunities that we see. On page 45, you see a page which is just a bunch of links to short videos that we provided you for if you wanted to have a quick snapshot, less than 5 minutes, well, between 5 and 10 minutes each, where you can have a quick download of our views on the 3 core views that our portfolio is made of. Peripheral European equity through optionality. The second one has got to do with deflation trades, mainly in fixed income. And the third bunch of trades has got to do with Japan and the second phase of Abenomics. In those 3 videos, you can see a quick download of those views. Going into the specifics of these 3 views, although I'm spending far too much time, so I'll try to not go into all the details that you can anyway find in this presentation. On page 47, we started discussing Italy. Italy is in a very bad position, all too clearly. By the end of the year, they might go from 132, 133%, all the way up to 140% debt on GDP, public debt on GDP. That is very high, like many research papers have been written about the risk of debt on GDP to be higher than 90%. Italy had it above 100% for so many years, but now 140% is really, scary. And in addition to that, the youth unemployment is 43%. We can see that, unemployment is very high, and industrial production has fallen off a cliff, more than 26% in 6 years. GDP is almost 10% 10% in 6 years. Its GDP is at the same levels in purchasing parity that it was in year 2000, which is 14 years ago, which is just too bad. But this is the bad side of the story. The good side of the story is that Italy is an integral part of the European Union. Saving Italy means saving the European Union as it is today, and therefore, the tools to save the situations are in the toolkit of the ECB, and therefore we think that the ECB will do what's needed in order to at least delay this endgame to the over-indebtedness of peripheral European countries by a number of years. We think that they can step up their actions quite dramatically from here, and they will do so. And therefore, if there is a case to be made for a dissolution of the European Monetary Union, not the European Union, it's postponed a few years down the road. Some specific catalysts to Italy have got to do with the repayment of arrears. That has proven to be very difficult this year. Renzi, the Prime Minister of Italy, had committed to do it by September. He failed to do that. Is claiming that 30 billions are ready. In total, we are talking about 70 billion euros, which is 4.5% of GDP. So it would be a huge fiscal boost, which is just money that some SMEs are due, are owned, and have not been paid. But even the 30 billion that Mr. Renzi is talking about would be great help. He says that they are ready to be deployed. Bureaucracy has stepped in the way, but they should be deployed. I mean, we don't know about that, but clearly, if that happens, it will provide an added catalyst on it. In terms of valuation, Italy is very cheap, and we will see it in a slide or two. On page 48, what I just said, the GDP at constant prices is where it was in year 2000, is that's fallen off a cliff ever since the Lehman crisis, and the GDP quarter on quarter is, the right-hand side chart is in negative territory for the third time in a number of years, so it's triple-dip recession. On page 49, the debt to GDP ratio, you can see how much it increased for 105% at the bottom in years between 2002 and 2008 into all the way here where it is now, which is almost 135%, projected to be 140 by the end of the year. Industrial production falling off a cliff by more than 26% in the course of 6 years. On page 50, youth unemployment, 43%. The bottom was 20% in year 2007. So it could be said that it is slowing down now a little bit, but it's clearly an alarming territory. And clearly, whoever is surprised about deflation should not be that surprised, because with such level of unemployment, you can imagine the consequences in terms of consumer spending, consumer confidence, hiring plans for corporates, which are linked and they are a cause and an effect of it, and so on. And for the overall GDP formation picture for the country. The overall unemployment rate is between 12 and 13%, which is very high. The legal system on page 51 is visualized. Some of the structural reforms will need to tackle some of the biggest trouble that the country is involved with. For example, here is the average number of days that it takes to enforce a contract. You can see that Italy stands at double the same level for the second slowest country, and it's almost 3 times the number that is true for France and Germany. So there is a lot to be made. The government seems to be in a good position to deliver on some of these reforms, although with delay, and we are quite positive about it actually. On page 52, you see the 3 factors, the 3 catalysts that we think that will manage to bring Italy into a better position. So the German economy contracting itself, which was not to be given for granted, right? So in the last quarter, German economy itself is negative in terms of GDP, and inflation is very close to zero. Second, why is Italy to be saved now, and why is our views on Italy more positive now than they used to be? Because there is deflation, and deflation is making all European countries in the same boat, and deflation has got to be taken care of, because deflation is better for everybody, and it's death penalty for debt-laden countries like so many in Europe. And third, the geopolitical tensions. We already had this argument where the tensions with Russia and the geopolitical tensions might create more cohesion about in between European countries and lead to common policies. So it should be possible for the ECB to do something about it, and we think they will do it. In terms of valuation, on page 53, you see, Italy is cheaper than Spain on a forward PE basis and on a also price on book value, 15% discount on average. And obviously there is a much bigger discount vis-a-vis Germany and US stocks, which are in total bubble territory in our opinion. And so we think that this value can be extrapolated and can be grabbed, when the mutuality across European countries on a monetary basis is guaranteed by an active ECB, which is all too scared about deflationary trends, which is allowed to act by a Germany which is contracting itself and itself seeing deflation. On page 54, you see the price on book value analysis for Italy, which is clearly better than it is in other countries like Spain and Germany. On page 55, you see that borrowing costs are already a lot lower than pre-Lehman, and we think they will go even lower. We think that the BTP rate for 10 years will be 2% by year end and lower than that into next year. On page 56, one of our biggest concern is the biggest area of activity is the banking industry, where we see the most upside due to the imminent catalyst. So in addition to the ECB policies, which are due to make it cheaper for banks to lend, and they are kind of giving free money to banks also to engage in more of the same carry trades that they engaged in the last couple of years. But the ratios are not quite bad. Ahead of the AQR test, they put themselves in quite safe territory. The two of the best banks in Italy that we see are Banca Intesa and Unicredit, also the largest ones. Here we displayed also numbers for Monte dei Paschi, although it's not necessarily something that is within our portfolio. Actually, it's not. And Banco Popolare, although it's a more risky game. But this should serve as an example. For Banca Intesa, for example, we saw that the core tier 1 capital, which is the fully phased Basel III ratio, is for the second quarter above 13%, which is well above the rate that it should be in order to pass the test, and for the minimum requirement. The Tier 1 ratio is 13.7%, the total capital ratio 17%, impaired ratio 16%, and coverage ratio in excess of 60%. So those are good numbers. In terms of tangible equity on tangible assets, you see the comparison across banks in Europe on page 57. On page 58, you see the correlation to spreads. Our view is that deflation will bring spreads tighter, but that has got an inevitable effect also on these banks. Intesa and San Paolo and Unicredit have got a 50% negative correlation to spreads, which means that if spreads go tighter, they go up with a 0.5 beta, and that is one more element that will push them through. Some of the reason for it is obviously that BTPs are owned for 500 billion by local banks, and obviously they are involved with the carry trades. Those carry trades are cheaper than they used to be in terms of financing cost. The headline rate that they receive is lower, obviously, but it's still quite juicy compared with anything else available in the market. So we think that is to be a very good element. The expected TLTRO take-up for Unicredit and Banca Intesa are shown on page 59. We're talking about 14 billion on average, that closes our ideas on Italy. I would probably move on to the second market in peripheral European equity markets that we like, which is Greece. Greece went off a cliff this year, and it couldn't perform any worse than it did. Greek banks are the cheapest they've been in 10 years. They've never been lower in any significant fashion than the levels at which they trade today, even during the Lehman crisis, even during the sovereign crisis in Greece 2 years ago. And that is in stark contrast with their fundamentals, because their fundamentals have only improved. Greece, is closing the gap to negative GDP growth quite dramatically. It's actually one of the best beat on GDP expectations this year. If France, Italy, and Germany have disappointed, Spain has impressed, and Greece has impressed even more. Like some of those banks that we are invested into, like the National Bank of Greece, are already profitable. They already make money, and that is also in line with the GDP, which is improving. It's still negative, but it's very close to the zero line, and is expected to be into positive territory into next year. And the delta between the GDP last year and the GDP next year is going to be 5 points. So the improvement in GDP is going to be 5 percentage points over the course of 18 months, which in our opinion is going to be quite impactful. Why Greek banks are so cheap? I mean, a number of different reasons. I mean, Banco Spirito Santo jumped into default. Banco Spirito Santo went to the market in June, and a few weeks later it was found that there was fraud and financial irregularities. Obviously, the market was taken on the back foot and was all too concerned, and immediately made the equation between Banco Spirito Santo and Portugal and Greece. And and the Greek banks got affected by that. We think Banco Spirito Santo was an isolated case. There is no equation to be drawn, and that level of fear will eventually dissipate and fade away. In addition to that, there's been a string of negative news, profit warning by Erste Bank and a number of other banks, litigation risk, and big fines imposed on the Barclays for 10 billion euros and on BNP Paribas, but also on Barclays and Deutsche Bank, and which have put pressure on the valuations of Greek banks. And then most importantly, the AQR results, right? The AQR results, they are not to be given for granted for Greek banks. Greek banks have done a lot, but you never know. It might be true that their asset side is still too inflated. Like we can think of their assumptions on mortgages and the housing market. We can think about their lending to the SMEs and to consumer loans. There are a bunch of different factors in the balance sheet that could lead to more capital need for Greek banks, but we think that actually the AQR will be fine, and we think that the capital needs will be there, but will be in small and manageable amount, and will not be disruptive, and will actually create the bottom for Greek banks from where they can move into higher territory, and quite dramatically so over the course of the following 12 months. Once the AQR will be done and dusted, the uncertainty will be lifted over, and the upside potential will be open up for these banks, which have done already a lot in terms of taking care of the balance sheet and the decrease in their lending to household and businesses, which has decreased their leverage ratios, but also didn't do much help to the real economy. But they've done a lot also in issuing new bonds, so taking care of their funding gap. The government itself has been re-rated and upgraded by rating agencies twice already in the last 6 months, and they have a 12 billion funding gap for the next year, which is manageable. It's not a big one. They trade at historically low yield levels, which is impacting their finances for the government and for private companies as well, and so we look at it quite positively actually, and we think that the current valuations they provide a huge buying opportunity at these levels. Geopolitical tensions, as we said, they will fade away, at least for the relevant geopolitical tensions out there, which are at the moment the ones between Russia and the West over Ukraine. Russia imposed a food ban over European countries, which has affected quite a bit the strawberry production and so many other food out of Greece, so it didn't help. On the other end, we think that as these sanctions get lifted, this will prove a tailwind, or at least not an headwind anymore. Political uncertainties. February there are general elections. That has also created some, stepping back from investments into the country, and also the expectations that the June ECB actions were not were judged insufficient by the market, but we actually think that they were quite bold, and in fact they are being stepped up now, and they will be stepped up further. Page 61, IMF projections on 10-year government bond yields. As you can see, they are super low, and that is positive for the Greek market. The stock market indices, you can see how cheap they are. You can see against the DAX and the US S&P, how depressed they are and how close they are to the historical lows. But if you look at the equities between banks and corporates on the next chart on page 61, you can see that corporates have moved up. It's really the banks that have stayed very, very low. And we think that is the disconnect that is going to be taken care of by the markets in the following 6 months. In the next 6 months, the default probabilities by the IMF for Greek banks, they are as close to zero as they have ever been. Pretty much, they were lower than these before the Lehman crisis, but that is also quite positive for the stock market there. On page 62, we see the recent successful bond issuances by the government of Greece in July. They managed to raise 3-year bonds at 3.5% with 2 times oversubscriptions and more than 2 times oversubscription for their short-dated bonds. GDP forecast by the Bank of Greece for 2015 is 2.8. As I said, we are coming from negative territory, so it will represent a delta of 5% vis-a-vis GDP last year. Investor sentiment and net exports have been increasing. We know of the summer holiday season. We know how bad it was in Italy. We know how good it has been in Greece, at least from anecdotal evidence, and we think that will be also shown into the next GDP quarter numbers. Lower levels of austerity, as we said, we believe that is the direction that we're going into, and a small financing gap of 12 billion euros in the capital markets to be filled for the government into next year. Institutional investors have not yet reached a meaningful exposure to the Greek market. The Greek market is also a small one, overly concentrated in the banking sector, super concentrated, the most concentrated banking sector in Europe, and we think that it will overreact to positive developments over the course of the next few months. On page 63, you see the fundamentals improving also when looking at the Greek wages, unemployment rolling off, changing real GDP and current account, which has just gone positive after like a good 10 years into the rates. On page 64, you see positive elements for Greek banks have got to do with declining NPL formations, highly concentrated market, the conversion. One of the most interesting aspects now is the conversion of the deferred tax assets into fully loaded capital. Depending on how they decide to do it, obviously it will have a different effect and more powerful if they decide to do it in a way in which it's not dilutive to existing shareholders. But definitely it's something that we are talking about DTAs for in excess of 3 billion for most banks, MBG, Alpha Bank, Piraeus, and a lot. So it's a lot of money that we think will be very meaningful in the next few months. Concentration of the market is in the next few slides. We provided a bunch of data. On page 64, you see what they've done, what has been done by each one of the banks in terms of recap this year and new issuance. Their profitability is improving. On page 69, the estimates for their increasing revenues compared to 2013 and their loan book and planned cost savings. There is a lot to be grabbed there, which we think it will. On page 70, you see their capital adequacy ratios. You can see that there is in excess of 15% for all of the relevant banks there. The net result, the net operating profit, is already positive for National Bank of Greece on a yearly basis. It's also a positive for Piraeus Bank on a quarterly basis, and moving very close to the zero line, and then eventually positive into next year. Loan to deposit ratio between 80 and 120%. NPL formations have been slowing down, decelerating by quite a bit. And the provision coverage is quite good, although obviously the AQR will probably show that it's not good enough and something still needs to be done. On page 71, NPL formation again, liquidity improves and capital adequacy is strengthening. On page 72, more details about the NPL formation for National Bank of Greece, one of the banks that we think is very interesting in Greece. You can see the Greek division and the overall for the bank, the NPL formation has gone up to 23%. You can see that there is only a 20 basis point quarter-on-quarter increase with a coverage at 56%. So clearly it has slowed down quite dramatically compared with a great rate of increase in the several quarters before. NPL flows and cost of risk, you can see it on page 73, which is quite telling. And the CET1 ratio analysis, you can see it on page 74. MBG pro forma at 11.4%, which compares quite nicely and positively against the European peers. We cannot go into the details of the positions that we have in the book, but a lot of it has got to do with optionality, especially in the form of tradable listed instruments, and we like it a lot. Some of it has been depressed incredibly, massively by the weak Greek performance this year on the banking industry and trades at a fraction of its value. For some of those instruments, we see a 2 to 3 times target performance within the next 6 to 12 months. We think that the ECB actions are the main catalyst, but the AQR is also a huge catalyst ahead of us. And now the catalysts are really imminent, so if we are right or wrong, we will know very soon. On page 75, we start talking about Japan. Japan is very interesting. We think that it's entering the second phase of Abenomics. We would describe our views on Japan in three steps, like Abenomics lacks of traction, more BOJ intervention needed, and the burst of the Japanese bubble coming off. So we are quite positive and negative about Japan at the same time. I mean, we are quite positive in a first phase in which we see equity melting up, the Nikkei going to 20,000 plus, the yen debased further by BOJ policies, going to 110, 120, and then eventually we see a second phase in which all of a sudden the yen debases even further, but as a consequence of a debt crisis with equity going down, so bursting down, and credit spreads widening quite dramatically. That is our view in Japan. On page 77, you see the difference between the monetary policy in Japan and the one in the US. As far as we are concerned, we think that the Japanese policies are driven by desperation. They have a debt on GDP of more than 500%. In Japan, it's desperate level. There is no way back from debt in any meaningful way. There should be a huge GDP and a huge inflation in order to take it back. There is no GDP huge number. There is not even a small GDP number. Actually, the latest number were dramatically negative, and there is no inflation to be seen in any meaningful way, except for the bad news of tax increases like VAT. And we think that desperation will drive the BOJ added monetary stimulus in an attempt to achieve debt monetization, which means really not paying back on your debt except through inflation, which is a form of default, surely to a fixed income investor invested into their bonds, and that will be achieved through currency debasement, so devaluation of the yen in order to take off a lot of the debts. And in the US, the same is done, but in a less monumental fashion. It should be said that, for example, on average this year, the Fed printed something like $50 to $60 billion. Now they are left with the last $15 billion to taper off, but it's a lot, $60 billion. Last year it was $85 billion, as you know, per month, and Japan was already at $60 billion as far as Kuroda injected liquidity in the market following Abenomics, and $60 billion per month for an economy which is only 35% of the US one. So the debasement in the economy is really monumental. And the optimism that drives the Fed is because the Fed is thinks, and probably they are right, so that the recovery is around the corner. And definitely a lot of positive signs can be seen in the US market, especially in the real economy in the US. The stock market, we believe, is in bubble territory, so it's disconnected from the fundamentals. The fundamentals are catching up with the asset values only too slowly, and eventually equities could also come down, in our opinion. But at the same time, in the real economy, you see an improvement, so it's optimism what drives the monetary policy in the US, and very differently from Japan. And our one-liner in Japan is fight like a samurai or die as a kamikaze, meaning that it's it's quite like it's having cut the bridges behind you. There is no strategy left, but to increase on the same policy tools that you've already been working on, that they failed to achieve any meaningful results, but they are the only ones available, and so they will likely continue to do so. It should be said that monetary printing is not started with Abenomics and Kuroda. It was already there at the end of the 90s when Bernanke was advising the government authority in Japan. On page 78, you see the lack of traction, as we said. So the first tab, inflation is showing a cost push inflation. It's not a demand-driven inflation. The inflation is higher in Japan, but only because the yen is weaker, and that increases the energy bill when Japan has got to buy energy from outside of Japan now that their power plant have been shut down after Fukushima. And in addition to other, in addition to the VAT, etc., etc. So there are two negative reasons why inflation is higher. only optically so. So it's almost an optical illusion because of the VAT and taxes and because of the lower yen and the energy bill. The GDP itself, it was minus 7.1% year on year annualized in the period for April-June 2014. Corporate sales and recurring profits slowed in the second quarter. Real wages, the nominal wages are growing only very slowly, but real wages, they are still in negative territory. They are improving, but they are still in negative territory. Total debt on GDP, as I said, public-private above 500%. 250 is considered acceptable, but already overblown. And the population, Japan is the oldest population in the world, is set to shrink by 40% the working population by 2060, and the elderly ratio to reach 40%. On page 79, you see the CPI, so the first element, Tokyo tax-adjusted CPI at 1.3%, and you can see how difficult it is for them to achieve the the inflation target that they set themselves for, which is at 2%, and they are quite well off it, despite the VAT, despite a weak yen and the energy bill. So very likely they will need to step up their efforts in monetary terms. On page 80, you see CPI broken down into a few analyses. Month on month, the CPI trend, you see how bad it is, how close it is to zero again. It rose a pure 0.01% month on month. It was the weakest gain since January 2010. And the CPI month-on-month trend, you can see how bad it is as well. It dropped 0.2% month-on-month. It was the biggest drop since March 2013. So there is definitely lack of traction in terms of CPI. In terms of real GDP, you can see the line on the graph on page 81. The estimate was minus 6.8. It came even worse than that, at minus 7.1%. And we expect a shallow recovery momentum, in between now and into next year. On page 82, you see sales. The first contraction that was to be seen ever since early 2013. They were down 1.9% quarter on quarter, and you can see sales and the recurring profit, and you can see the catch-up. If the catch-up happen for profits going down, obviously is even worse, and is even more concerning for the central bank and the government. Nominal wages on page 83. I will not go too much into the details there, but you can see that the picture is not encouraging. On page 84, you see the population growth trends. You see a chart which just describes that. The working population in Japan is below 80 million people. It's the first time in 32 years. Last time it was here, it was in 1981. And, this doesn't help any GDP formation. It doesn't help inflation. It doesn't help any of the target that Japan has set himself for. On page 85, you see the working population compared with the other countries. You see how much worse it is. Not only Japan is already older than any other country in the world, but also it is set to go even older compared with other countries in the world, from Germany, which is the second worst, to Italy, to the US, to China, etc., etc. So the second tab is more BOJ intervention. We think that Kuroda and the Bank of Japan will have to step up their games. The recent statements from Kuroda, they seem to be hinting into additional easing quite a bit. Here on page 87 we have like an extract from a recent speech of Mr. Kuroda. They need to do that in order to keep the momentum alive, debase the further the Japanese yen, and monetize an otherwise unbearable debt overhang. On page 88, you see what is happening to the yen. The yen is just reached 108, 109. We think it has broken a JPY trend which lasted for more than 10 years, actually 20 years. And we think that the next trend line shows a 120. So it could accelerate from here, and at some point within the next 6 months, we think it will. With the US economy gaining traction, or without it, with the BOJ being forced into further action. So it's really central bank driven, and we think that it's quite important what happened in the last months, where it broke important resistances and moved into new highs or new lows. On page 89, you see the first phase of an additional BOJ intervention. As far as we are concerned, we think there will be an even lower yen into 110, 120, higher level of equities, the Nikkei going up to 20,000. At the moment, the Nikkei has not catched up with the level of the yen, typically did in the past. In addition to that, the equity, as previously a year ago, already priced in a premium to the interest rate differential and to the level of the yen, so it was even higher than the weak level of the yen, and now it's the opposite. It's backed off a bit. So we think there is a huge upside there, but only nominal terms, because it's going to be offset by a weakening currency. And then a tighter credit spreads. Credit spreads are already very, very low for some companies in the private sector which are overly levered and overly exposed to China, for example. It's already quite low. They trade at credit spreads between 10 and 50 basis points on a 5 to 10 year basis sometimes. But we think that with the renewed intervention by the BOJ, they could go even tighter. And then there is a second phase, which is the burst of the bubble, in our opinion, which can be 1 year, 2 years, 3 years from now, which entails, again, a lower yen, but lower yen which does not come because of the currency debasement done by the BOJ, but also because of a debt avalanche, debt crisis, and the fall of confidence in the economy itself, and the overly, the base currency itself, and the level of indebtedness, the inability to pay back on debt other than through monetization. Lower equity, which is at that point the fall of confidence will drive lower equity valuations, and at that point higher rates and wider credit spreads. On page 92, you see how we implement that into trades within our books. We have 10 times payout ratios on devaluation scenarios on the yen. We see a substantial nominal upside on equities, nominal upside because it's going to be counterbalanced by the devaluation of the yen. Nikkei at 20,000. And then finally, we start an accumulation program here of credit spreads on weak companies, which they don't deserve to be trading at tight levels on their credit spreads. And here we won't go into the details, but there are various things that we are looking at. We screened in excess of 300 names. We are on page 93, which are challenged by macro trends. I'm thinking at the private sector in Japan, trading at these tight bubble unsustainable levels, and the most important catalyst to a widening of those spreads can be Abenomics failure, excessive level of indebtedness for themselves. Sometimes they are exposed to other emerging market currencies. Sometimes they are exposed to China, for example. You know how much the relationship with China are in a bad state for the first time in 40 years. China and Japan had better relations after the World War II than they have today. In a way, back then the trading partnership was bigger than what it could be today if the tensions were to escalate. Sell-off in JGBs is another catalyst. The burst of the Nikkei bubble is another catalyst. The sell-off in the commodity prices, as it is happening already, and the slowdown in the China's growth. On page 94, you see the metrics that we utilize in order to screen the companies that we want to short on credit spreads, in order to hedge this second phase of Abenomics and the burst of the bubble in Japan. And the metrics are, the bigger the circle, the more important the metric is for us. And on this universe of 300 companies, we look at the things like debt equity, exposure to China, interest coverage ratio, sensitivity to interest rates, net debt on EBITDA, but also EV on EBITDA, P on book value, PE themselves, and then debt assets, and so on and so forth. On page 95, you look at the potential outcomes. Abenomics failure, these optional strategies could pay off handsomely, 200, 300 times. In case of no Abenomics failure, but Abenomics being successful, they still will pay a lot because of the stabilization of inflation moving higher and credit spreads moving closer to their peers trading in Germany, Russia, and the US. So bottom line, both outcomes can lead into a very strong payout ratio, max payout ratio, and some of the optional strategies that we utilize to hedge the Abenomics, second phase of Abenomics. If Abenomics is successful or not, it doesn't really matter for the strategy too much, given the fact that they trade at levels which are very difficult to sustain in both cases. So some of these strategies are multi-year, so it might take years for them to materialize, but they are inexpensive at these levels, and therefore they can be held and funded for a long horizon. Thank you very much. Sorry if it took too long today's conference call. We remain available for your questions, so please drop by an email if you want to ask us further clarifications about the books. Thank you for your time, and bye-bye.